Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Hurd, Senior Portfolio Manager in the Currency Group of State Street Global Advisors. Aaron, it is great to have you with us. Welcome to Trade Talks.
Thank you. Thank you for having me.
You got it. And what are your expectations as it relates to the landing scenario and central bank policy?
We expect a bumpy landing. So not a hard landing, not necessarily a soft landing, right? Bumpy landing. So we have probably about a 50-50 chance of having a recession, we think. If we do have a recession, it's likely to be mild, right? The consumer is fairly strong and resilient. The labor market is excellent, right? Kind of surprisingly so. And there are still widespread labor shortages. So you have that underpinning of strong consumer demand, and corporate and bank balance sheets look pretty healthy, right? So a deep recession at this point doesn't look in the cards. But you do have what's going to likely be about 500 basis points or 5% of Fed policy tightening, right? And that still has quite a while before it all fully affects the real economy and works through the system, right? There are long and variable lags, as they say, in the impact of monetary policy. And the consumer is running out of some of that extra cushion, right? Partly because real incomes have gone down, and partly because they're running through the savings from the pandemic stimulus. So we see a reasonable slowdown. Now, the upside of that, and what the Fed will be happy about, is that we believe the disinflation that we've seen over the last few months will continue and get us back down into the high 2% range by year end, right? Which is a good positive, and that will allow the Fed to at least pause. But again, with the tight labor markets, it's hard to see them cutting. I'm a little skeptical of the 3 cuts that the market has priced in now.
And outside of macro, what are the remaining risks?
I'd say, right, outside of macro, you still have to look at the geopolitical risks, which in and of themselves are macro kind of in nature. But Russia and Ukraine, the number of market-moving news events that come out of Russia and Ukraine has diminished, but it can re-intensify. Right, as fighting is still vicious and a lot of bad things can happen. There's been a rhetorical de-escalation between US and China that likely persists for most of this year. China has a lot on its plate with the reopening and trying to get growth back up to where it wants it. But still, the fundamental tensions and problems are still there. And we still have China-Taiwan potential tensions on the horizon. So that could flare up at any time. Again, not central case that it's a huge issue this year, but it is there and could come to bite us.
And you expect to see a soft dollar over the next few years. Why is that?
I do. So I expect the dollar to go down another 10 or 15%, probably closer to 15% over the next few years. Now that's on top of the 10% we just moved, right, since October. So that's in total, I'm talking around a 25% correction in the dollar from the highs, which is pretty substantial. And the reason for that, I think, maybe is best explained by looking at why it was so strong, right? So the Fed led the way. So there was a big interest rate advantage in the US that attracted capital, very attractive, high interest rates, good for a currency. But if you look at a currency pair like euro dollar and say, where are interest rate right now? The US has an advantage. But on average, historically, over the last decade or so, that US interest rate advantage is equivalent to about a euro dollar trading at 120. We're trading around 108, so substantial discount. And we were trading in the 90s, right? So a 20-25% discount. That's an extra risk premium because of those geopolitical risks I mentioned, as well as growth risks, right? Now, some of those are alleviated. In that energy prices have fallen significantly in Europe with the milder weather. As I said, Russia, Ukraine's not creating quite as many market-moving headlines. And so we've seen some of that extra risk premium come out, right? But currencies move far more than the interest rate advantage of the US would have suggested. Currency move far more than the interest rate differential would have suggested. And that is that risk premium. And I expect that risk premium to come out as we wring out inflation and get to more of a sustainable global growth path, which means probably this year is more of a transition year, and the dollar's not going to keep going straight down as it has been.
How do other developed market currencies rank versus the dollar?
Well, I was picking on the euro there, right? With current interest rate differentials, euro dollar should be around 120. There's that nice extra risk premium. I like that. Right. And I like the euro. I like the fact that there's quite a lot of stimulus in the system in Europe that has not been spent, including the recovery fund from a couple of years ago. So that's a bit of a positive as well. So less recession risk because energy prices are down and the weather's mild, and a little bit of fiscal stimulus with a nice discount in the currency. So I do like that. Again, maybe it's a little overdone in the near term, having already rallied up to 108, but going forward, I like that. The yen also looks reasonably attractive. I would not chase it here, right? We've come from 152 all the way down to 127, now around 130. But if dollar yen rallies up, I would sell that, buy the yen, sell the dollar, because I do expect after this period of tight monetary policy for policy rates to go back towards neutral. In the US, maybe that's 100, 150, even 200 basis points lower than peak Fed funds. That's good for the yen. And the yen is somewhat protective in the case that we have a deep recession, which is still a meaningful risk, right? Once we see all of the monetary tightening hit the real economy, we may be in for a much deeper and prolonged recession than we'd like, and certainly than the Fed would like. In that case, we'll get that yield compression, and the yen tends to do reasonably well during that time of economic stress. So it's not a bad, it's a pretty good currency as well to get long and play this dollar turn. But again, you want to be patient with entry. You don't want to chase it. It's had such a big move.
And finally, Aaron, what about emerging market currencies?
So I'm talking about a bumpy landing, right? 50-50 chance of a mild recession. That's a difficult environment to just go out and broadly buy EM, right? We have China reopening, which is a great positive. And that's certainly going to help Asia. But you've seen almost a 16% rally in the Korean won, South Korean won, just over the past 3 months. So a lot of that move is already priced. Seen similar very large moves in Eastern Europe. Hungarian forint, for example, has moved 15 to 20%. So with these large moves, it's hard to chase it here. Now I do like, again, same story as Euro, some of the higher yields and risk premiums in EM, but you want to be patient in getting in and picking your spot. So Hungarian forint stands out and get a 16% yield in the currency forward market, which is quite attractive, and it's still on the cheap side of fair value.
All right. We appreciate the insight, Aaron. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.